Hey all, David here. Let's talk about that word, that term that we've used a lot lately, and that's liquidity. What does that really mean? Well, to us as an investor or with capital, it means fungibility. It means how quickly can we get access to that capital and move it somewhere. Move it back into our hands, to a bank account, or move it to another investment. How liquid is that money? Typically, we think about deposits in the bank as being very liquid. They're called on-deposit accounts or on-demand accounts because on demand, we can go and ask for that money out of the bank tomorrow. And the bank is supposed to be able to give it to us, although recently that's been a problem at a few banks. So even that liquidity has been a little bit challenged, if not for the backstopping of the FDIC, which is really backstopped by us, the taxpayers. But without going further with that, let's think about other aspects. U.S. treasuries, considered even less risk than, I guess, putting money in the bank today, because unless the U.S. government defaults, those treasuries will always get paid. I know we have a debt maturity conflict that's coming up here in the next few weeks, but my guess is they'll go ahead and extend the debt ceiling again, because defaulting on U.S. obligations for even a day would be a travesty and would cause ripple effects throughout the globe. So that's not likely to happen. But going back to the treasuries, I can put it in the marketplace for a very short time. In fact, if I do it through a brokerage account, it's very fungible. I could put some money there and get it back out tomorrow. So very, very highly liquid, depending upon how long you leave in the treasuries, or if you ladder treasuries, you could go out a few weeks to 30 years if you want to. But again, relatively liquid, right? Get my hands on that with a lot of certainty. That's the point. How certain is your liquidity? What if I put it into precious metals like junk silver? Pretty darn liquid, right? Especially if I actually hold that junk silver somewhere where I can get my paws on it, right? Like in the backyard or under the mattress. Maybe in a safe deposit account, safety deposit box at a bank. Although if the bank closes and shut down, then I can't get access to it, right? So that's, again, could be a factor in liquidity. So other precious metals, gold, certainly same thing. Ammo. Ammo is pretty fungible, right? At least in my neck of the woods here, I could probably take my ammo holdings, and probably within my radius of my walking my dog button, I could probably parlay that ammo off and get barter it for anything, including whatever currency I wanted. That's just another example of liquidity, right? Now, it'd probably take a lot of ammo to stack up any significant liquidity, but I mean, it gets, again, something. So it's something that has exchangeability very easily in the marketplace, where I can exchange what I hold, to someone else, and I can get what I want with that exchange. Now, typically, currency is how we do that. Currency is how we make those exchanges. We can make that happen. Our businesses are not liquid, right? Now, maybe a little bit liquid, because maybe we could go to the bank and we could refinance some equity out. But again, that's not super guaranteed, and if banks stop lending money or tighten credit much more than they have even today, that may not be a possibility. So then you have to sell a business. Well, that's not very liquid. That takes time, unless you put it on the market and sell it for a fire sale. Real estate. Well, kind of the same thing. Equity ownership in real estate, whether it's my home or rental property or putting money in a syndication or a fund. We'll get to funds in a minute. But those equity syndications or equity ownership, not very liquid, right? You've got to sell or maybe refinance to get equity or get cash back out again. Debt, holding debt as an asset, more fungible, more liquid than equity. Typically, because again, holding debt is a contract with a borrower, and that contract states a specific term, states specific return on the principal loaned, and has a maturity date. Now, it only becomes not fungible, not liquid, if the borrower defaults. And then I have to work my way back through the collateral and then do what I want to with the collateral to get my money back. So, but in most cases, having a note receivable that's well constructed, vetted, good borrower, I can take that note receivable and I could sell it, assign it to somebody else, maybe even a bank, but usually I think about private markets. Somebody actually in Freedom Founders who would say, yeah, I take a great note receivable, David, in my IRA account, because interest is great in your IRAs, and it could be priced. Maybe if the interest rate was good enough on it, like 12% or more, I might be able to sell it at par. In other words, what the balance currently is on it. maybe I'd have to discount it a little bit to sell it more quickly to who would either take it at par or maybe a slight discount. My point is I could get my capital out of that. Harder to do that with a piece of real estate, right? Would you like to buy my rental property over here in North Dallas? Well, not really, because now I got to manage it and all that stuff. But a note receivable, I don't have much to manage there. So see the difference in debt versus equity on a typical fungibility basis. All right, let's get to funds. Debt funds or lending funds to, in some cases, allow for more flexibility, more fungibility, more liquidity. There's terms, right? Lockup terms that in most funds go out maybe 3 years. I'm talking about debt lending funds. 3 years is probably the maximum. Then you can come back in somewhere 2 years. A number of them are set at 1 year, 12 months. We have a good number that are set at like 6 months or maybe a couple at 6 months. A number that are at 90 days. We've seen even outside, we've seen Blackstone, BlackRock, Starwood, a number of the bigger public funds in the last 6 months have, put gates or put the cap on the amount of redemptions that investors could ask for, even if they had a redemption feature of 30 or 90 days. They say can't do it. So what's that mean to us? Here's the point I'm trying to make after all this dialogue. Liquidity in a fund is only as good as the liquidability, fungibility of the assets in that actual fund. What do I mean by that? Well, I just got through talking about equity versus debt. Debt, income streams, can be sold and redeemed and turned into cash in the marketplace a lot easier than equities. So if somebody has an equity fund, a single family portfolio, that's equity, right? Yet he offered a 90-day redemption feature. How could he do that? Are those assets easily liquidated? No, I just got through saying to sell equity, to sell rental properties, it can take some time. I mean, even if you fire sale them, wholesale them at discount prices, still takes time to go through buyers checking it out, doing due diligence, getting their funding in place, blah, blah, blah. It could still take 30, 60, 90 days. So that's not really highly fungible. And if a number of people wanted to get their capital out, then they have to sell a whole bunch of their portfolio, which is just not gonna happen. So even though 90 days were promised, it's not feasible, is my point. Now, a lending fund, assuming that's what they have in their fund, more feasible, but still to flood a marketplace and having to redeem too much of the paper being held would be hard for even a fund with debt holdings in it. So that's my point. Oh, another example, just before I lose my thought. Silicon Valley Bank, that was their problem. They had a lot of depositors with demand deposits in that bank. And when they started to get that bank run, or let's call it a bank walk, well, it was a bank run. It was not a walk, it was a run. A flood of money coming out. What were the assets that they held? The primary assets they held, it's not cash in the vault. No one keeps cash in the vault. No banks do. They got to keep it out there earning something. So they had most of their assets in long-term maturity treasuries. I mean, like out to 10 years. And also in mortgage-backed securities. Those are mortgages. And while those are sellable, treasuries we talked about, they're sellable. Yes, definitely sellable. There's a market for them. And mortgage-backed securities, they're definitely sellable. What was the problem? Because they were long dated, meaning the maturity dates were out here some 10 years or more, and they were typically with coupon values, that is the interest rate on the face of those securities, were like under 3%, because when they invested in them, it was like 2 or 3 years ago before rates went up. I'll buy those securities, but I need like at least 12%. So to get that 12%, he'd require the seller, this case Silicon Valley Bank, to sell those treasuries or mortgage-backed securities at a severe discount. And that's what happened. So when it came time to call in their assets to try to pay the depositors, they couldn't do it because they couldn't sell enough assets at the discounts required in the marketplace to redeem the demand deposits for their investors who wanted it. So I hope this gave you a little bit more of an explanation about liquidity. So when you're thinking about, these funds that offer liquidity, the question you need to ask on your personal due diligence is, what kind of assets do you have in your fund? Like, how long dated are they? I mean, some of the funds that are offering liquidity have both notes receivable, that is debt, and have some equities. Now, I think it makes for a stronger, more diversified fund. I do like that aspect. But again, how can that fund promise Again, they're not guaranteed promises. It's always at the manager's discretion, right? So that's where it's not a promise. How can they, offer liquidity in 6 months or less? Well, they're just hoping that not enough people want to get the money out. Many cases, they're relying on more capital coming in, because when you want a redemption, it's not like they have a special bucket where they hold all of your capital. So if any one of you want their money, it's not like it's in the bank. Just like the banks don't hold, if you have $100,000 in your checking or savings account, the bank is not holding it there in their vault for you. They have some reserves, but it's very low based on the amount of demand deposits they have. So same thing with our fund manager TAs. No way they can have a restricted account to keep all the capital they promised it for 90 days. They're ready to go slip moment. Can't do it. And there's no way. It wouldn't be viable. They couldn't offer that to you, or they'd have to reduce your rate of return on that money from the 9% or whatever it is down to 1.5 or 2%, like a bank, right? So these are the risks we take. That's why when we talk about liquidity, you need to kind of ladder that liquidity. Keep some cash, keep some in treasuries, keep some in precious metals, and realize that liquidity comes down to what are the assets that back that investment? What backs it? How liquid are those assets? That's what makes liquidity. All right, I went longer than I thought I was going to go here, but I wanted to roll that out to give all of you more context, because this is something that's important to us now and be an important conversation, I think, as we go forward into the markets in the not just this year, but I think for years going forward. There's going to be a lot of volatility, a lot of up and down, up and down, up and down. And to best understand how to allocate your capital, you need to be aware of the up and down. It's not going to be a steady run up like we had the last 14 years, and then we have a recession correction, then we go back up again. It's going to be boom, 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 boom. I see a lot of this going forward, and I think we just need to get in tune with that, be more discerning about what our expectations are as investors ourselves. All right, I'll cut it off there. Talk to you soon.